So the latest on trade, China reciprocates, slapping 25% tariffs on more than 100 US goods. Our strategists believe the threat of a trade war is the #1 risk now for global markets.
In these trade war games, it all depends on who responds next and how. For global market dynamics to transition from a cold trade conflict to an actual global trade war, we need to see either the US counter-retaliating to China by imposing blanket tariffs on all Chinese import goods, or the US broadening out its protectionist measures to other countries or sectors.
So what does all this mean for global markets? We have already seen some sell-offs in equities.
But it's worth noting that trade wars in isolation do not cause a sustained global downturn, nor a sustained sell-off in risky assets. One saving grace in the modern world is the independent monetary policies that we have and flexible exchange rates. So if trade wars were to escalate, one could expect central banks to slow down any monetary policy tightening. This de facto easing of financial conditions would provide a backstop to any equity market sell-off.
Well, Viraj is our FX strategist, so what does all this mean for the US dollar and other currencies?
It's clear the White House wants a weaker dollar, and their protectionist measures merely reinforces this message. We still think there's a further 3 to 5% decline in the trade-weighted dollar this year. We reckon dollar-yen remains the best vehicle to hedge for the prospect of a global trade war, and we could see a move down to the 100 level if things were to heat up. Other currencies caught in the crossfires could be the Australian dollar, which could move lower on the back of escalating US-China trade tensions. Equally, the Canadian dollar looks vulnerable if Trump were to take a step back on NAFTA renegotiations.